January 26, 2025. Sarah Mitchell gets a letter from the IRS. She settled her credit card debt last year, $8,000 reduced to $4,000. Thought she was done. The IRS letter says she owes $1,200 in taxes, plus penalties, plus interest, on debt she doesn't have anymore. She calls the debt settlement company. They say, "Oh yeah, forgiven debt is taxable income. Didn't we mention that?" They didn't. You seeing this? Here's the IRS trap nobody tells you about, and how it turns debt relief into a tax bill. I just got a tax bill from the IRS for $1,200 on the debt you settled. Did you know about this? Oh yeah, forgiven debt is taxable income. It's in Section 11 of your contract. You should have consulted a tax advisor. You should have consulted a tax advisor. That's what they say after they take your money. The debt settlement company tells you, "We'll settle your debt for 50 cents on the dollar." What they don't tell you, the IRS considers that other 50 cents as income. Taxable income. Let me show you how this works, because this is where the math breaks. Here's the math they show you. Original debt, $8,000. Settlement offer, $4,000. Money saved, $4,000. That's what the debt settlement company tells you. You save $4,000. But here's the math they don't show you. That $4,000 you saved, the IRS calls it cancellation of debt income. Your tax bracket, let's say 22%. Tax on $4,000 at 22%, $880. But wait, you also paid the debt settlement company a fee, 25% of your enrolled debt. 25% of $8,000, $2,000. So here's your actual cost. Settlement payment, $4,000. Company fee, $2,000. IRS tax bill, $880. Total paid, $6,880. Original debt, $8,000. Actual savings, $1,120. You seeing this? They told you you'd save $4,000. You saved $1,100, and you still owe the IRS. This is IRS Form 1099-C, cancellation of debt. Creditors are required to file this with the IRS when they forgive more than $600 of debt. Let me show you what's on here. Box 1, name of creditor. In this case, Capital One Bank. Box 2, amount of debt canceled, $4,000. Box 3, interest included in Box 2, 0. Doesn't matter for our purposes. Box 7, fair market value of property, not applicable. And here's the important one. Box 2, $4,000. The IRS gets a copy of this form. So does the debtor, and the IRS computers automatically match this form to your tax return. If you don't report that $4,000 as income on line 8 of your 1040, the IRS sends you a CP 2000 notice. That's the letter Sarah got, saying, "You forgot to report this income. Here's your tax bill, plus penalties." Here's what happens on the IRS side. Capital One files the 1099-C electronically, reports $4,000 of canceled debt. That data goes into the IRS computer system, gets matched to Sarah Mitchell's Social Security number. April 15th, 2025. Sarah files her tax return, reports her W-2 income, $45,000 from her job, but she doesn't add the $4,000 from the 1099-C. Why? Because she didn't know she had to. IRS computer runs the match. Form 1099-C says she received $4,000 in debt cancellation income. Her 1040 says she didn't report it. Mismatch. Automatic CP 2000 notice generation. No human reviews this. It's automatic. You get the 1099-C in January, you report it in April, or you get the bill in June. That's the system. And here's where it gets worse, because it's not just the tax. Base tax on $4,000 at 22%, $880. Failure to report penalty, 5% of unpaid tax per month up to 25%. Let's say she gets the notice 3 months after filing. That's 15%. 15% of $880, $132. Interest on unpaid tax, currently about 7% annual. 3 months worth, $15. New total, $1,027. But wait, if she doesn't pay within 30 days of the CP 2000 notice, the IRS adds a failure to pay penalty, another 0.5% per month, and interest keeps compounding daily. So that $4,000 of forgiven debt, it's now costing her over $1,000 and climbing. This is the trap. But here's what the debt settlement companies never tell you, and what the IRS doesn't advertise. There are exceptions, legal ways to avoid paying tax on canceled debt. Most people qualify for at least one of them, but you have to know they exist, and you have to file the right form. Let me show you. IRS Publication 908, Bankruptcy Tax Guide, lists 5 main exceptions to cancellation of debt income. Here they are. Exception 1, bankruptcy. If the debt was canceled in a Title 11 bankruptcy case, it's not taxable, period. You file Form 982 with your tax return. Check the box that says, Discharge of indebtedness in a bankruptcy case. No tax owed. This is the cleanest exception. Bankruptcy wipes the debt and the tax liability. Exception 2, insolvency. If you were insolvent immediately before the debt was canceled, you don't pay tax on the forgiven amount, up to the amount you were insolvent. Insolvent means your total debts exceeded your total assets. Example, total debts $25,000, total assets $15,000. You're insolvent by $10,000. Creditor forgives $4,000. All $4,000 is excluded from income because you were insolvent by $10,000. You file Form 982. Calculate your insolvency. Exclude the canceled debt. No tax. This is the exception most people qualify for and never use because they don't know it exists. Exception 3. Qualified farm indebtedness. If you're a farmer and the debt was incurred in your farming business and more than half your gross income in the last 3 years came from farming, you can exclude it. Narrow exception, doesn't apply to most people. Moving on. Exception 4. Qualified real property business indebtedness. If the debt was incurred in connection with real property used in a trade or business and the borrower was not a C corporation, you can exclude it. Also narrow. Doesn't apply to consumer credit card debt. Next. Exception 5. Qualified principal residence indebtedness. This one expired in 2020. It covered mortgage debt forgiven on your primary home. Congress occasionally extends it. As of 2026, it's not available, but keep an eye on it. If you're settling mortgage debt, check if it's been extended. 5 exceptions. 2 of them, bankruptcy and insolvency, apply to most people settling consumer debt. But the debt settlement companies, they don't tell you about these. Why? Because if you knew you could discharge the debt in bankruptcy with no tax bill, you wouldn't pay them $2,000 to settle it and stick you with an $800 tax bill. Let me show you how the insolvency exception works, because this is the one most people can use. Insolvency. This is the exception the IRS doesn't advertise and debt companies never mention. Here's how you calculate it. I'm going to use Sarah Mitchell's actual numbers. Grab a pen, this is important. Step 1. List all your debts immediately before the debt was canceled. Sarah's debts on September 1st, 2024, the day before her settlement. Capital One credit card, $8,000. Chase credit card, $6,500. Discover card, $4,000. Car loan, $12,000. Student loans, $18,000. Total debts, $48,500. Step 2. List all your assets on the same date. Checking account balance, $1,200. Savings, $800. Car value, Blue Book says $9,000. Retirement account, 401k, $14,000. Personal property, furniture, electronics, clothes, let's be generous, $3,000. Total assets, $28,000. Step 3. Subtract assets from debts. $48,500 minus $28,000 equals $20,500. Sarah was insolvent by $20,500 immediately before the debt settlement. Step 4. How much debt was canceled? $4,000. Step 5. Compare. Insolvency, $20,500. Debt canceled, $4,000. Since the canceled debt is less than her insolvency, the entire $4,000 is excluded from income. She files Form 982 with her tax return, reports her insolvency, excludes the $4,000. IRS gets the 1099-C from Capital One, matches it to her return, sees Form 982, no mismatch, no tax bill, $0 owed to the IRS. You seeing this? She qualified for the exception, she just didn't know it existed. Now I'm going to show you Form 982. This is what you file to claim the insolvency exception. IRS Form 982. Reduction of tax attributes due to discharge of indebtedness. It's 2 pages. Looks complicated. It's not. Here's how you fill it out. Top of the form, your name and social security number, Sarah Mitchell, SSN. Part 1, general information. Line 1, Box B. Check this box. Discharge of indebtedness to the extent insolvent. That's it for Part 1. Part 2, reduction of tax attributes. Line 2, enter the amount excluded from income, $4,000. Rights, $4,000. Lines 3 through 10. These reduce your tax attributes, things like NOL carryovers, credit carryovers, basis in property. Most people don't have these. Sarah doesn't. Leave them blank. That's the whole form. Check box 1B. Enter the excluded amount on line 2. Sign it. Attach it to your 1040. IRS gets the 1099-C from Capital One showing $4,000 canceled. They see Form 982 showing $4,000 excluded under insolvency. Match. No tax bill. No penalty. Done. But here's the critical part. You need proof of your insolvency. That worksheet I just showed you? Save it. Print it. Attach it to Form 982. The IRS might audit you. If they do, they'll ask, how did you calculate your insolvency? You hand them the worksheet. Bank statements from that date showing your balances. Car title showing the loan amount. Credit card statements. Student loan statements. Everything documented. Everything dated. That's how you defend the exclusion, with math and documentation. Most people never get audited on this. But if you do, you need to prove you were insolvent. Keep the records. But here's what most people don't realize. If you're insolvent enough to exclude canceled debt from taxes, you're probably insolvent enough to file bankruptcy. And bankruptcy is cleaner, no tax bill, no Form 982, no audit risk. Let me show you why bankruptcy is almost always better than debt settlement, especially when you factor in the IRS. Same person, same debt. $20,000 across 4 credit cards. Left side, debt settlement. Right side, Chapter 7, bankruptcy. Watch what happens. Debt settlement. Month 1, enroll with settlement company. Pay $1,200 setup fee. Months 1 through 12. Pay $300 per month into settlement account. That's $3,600. Month 12. Company settles first card for 50%. You pay $5,000 to creditor. Company takes 25% fee. $1,250. January next year, IRS Form 1099-C arrives. $5,000 in canceled debt. Tax bill, $1,100. Months 13 through 24. More payments, more settlements, more fees, more 1099-Cs. End of 24 months. Total paid to creditors, $10,000. Total paid to settlement company, $5,000 in fees. Total paid to IRS, $2,200 in taxes on canceled debt. Grand total, $17,200. Original debt, $20,000. Actual savings, $2,800. Credit score, 540. Won't recover for 7 years. IRS audits you on the insolvency claim. You didn't file Form 982 because you didn't know it existed. Tax bill stands, plus penalties. Chapter 7. Bankruptcy. Month 1. Consult bankruptcy attorney. Free consultation. Hire them. Fee, $1,500. Can be paid in installments. Month 2. File. Chapter 7. Petition. All collections stops immediately. No more calls, no lawsuits, no garnishments. Month 3. Attend 341 creditor meeting. Takes 15 minutes. No creditors usually show up. Month 4. Discharge granted. All $20,000 of unsecured debt legally eliminated. January next year, no 1099-C. Bankruptcy discharge is excluded from income under IRS Code Section 108A. No tax bill, ever. End of 4 months. Total paid to creditors, 0. Debt is discharged. Total paid to attorney, $1,500. Total paid to IRS, 0. No tax on bankruptcy discharge. Grand total, $1,500. Original debt, $20,000. Actual savings, $18,500. Credit score, 540 initially, but starts recovering immediately. Back to 680 in 2 to 3 years. IRS, no audit risk. Bankruptcy discharge is explicitly excluded from income. Same debt. 2 paths. Debt settlement, pay $17,200, save $2,800, 7-year credit recovery, IRS audit risk. Bankruptcy, pay $1,500, save $18,500, 3-year credit recovery, 0 tax bill. You seeing this? The debt settlement industry exists because people don't know bankruptcy is an option, or they think bankruptcy ruins your life. It doesn't. Let me show you what bankruptcy actually does. The debt settlement companies want you to think bankruptcy is the worst thing that can happen to you. Here's what they say, and here's what's actually true. Card 1. Flips. Myth. Bankruptcy ruins your credit forever. Reality. Bankruptcy stays on your credit report for 10 years, but your score starts recovering immediately. Most people hit 680 plus within 3 years. Debt settlement keeps your score low for 7+ years while you're in the program. Myth. Bankruptcy ruins your credit forever. Reality. It's on your report for 10 years, but your score starts climbing immediately after discharge. Most people hit 680 within 3 years. Debt settlement, your score stays in the basement for 7 years while you're enrolled, then takes another 2 years to recover. That's 9 years total. Card 2. Flips. Myth. You'll lose everything you own. Reality. Chapter 7 has exemptions that protect most property. In Texas, unlimited homestead exemption, $50,000 personal property, retirement accounts fully protected. Most people lose nothing. Myth. You lose everything. Reality. Chapter 7 has exemptions. Texas example, unlimited homestead protection, $50,000 in personal property, full retirement account protection. Most people filing Chapter 7 lose nothing. You keep your car if it's under the exemption. Keep your house if you're current on payments. Keep your retirement accounts. Card 3. Flips. Myth. Employers can see your bankruptcy and won't hire you. Reality. Bankruptcy is public record, but most employers don't check. Federal law prohibits government employers from discriminating based on bankruptcy. Private employers rarely check unless you're applying for financial positions. Myth. Employers won't hire you. Reality. Most employers don't check bankruptcy records. Government employers legally can't discriminate based on bankruptcy. Private employers rarely check unless you're applying for a CFO position. Card 4. Flips. Myth. You can't get credit for 10 years after bankruptcy. Reality. You can get a secured credit card 1 month after discharge. Car loans available within 6 months. Mortgages within 2 to 3 years. FHA allows 2 years post-discharge. Myth. No credit for 10 years. Reality. Secured credit card 1 month after discharge. Car loan within 6 months. Interest rate won't be great, but you'll get approved. Mortgage within 2 to 3 years. FHA allows mortgages 2 years post-discharge. Card 5. Flips. Myth. Bankruptcy costs $5,000 to $10,000 in attorney fees. Reality. Chapter 7. Attorney fees. $1,200 to $2,000 in most states. Many attorneys allow payment plans. Court filing fee, $338, can be waived for low income. Myth. Bankruptcy costs $10 grand. Reality. Chapter 7. Attorney fees run $1,200 to $2,000 in most states. Court filing fee, $338. Total, $1,500 to $2,500. And most attorneys let you pay in installments. Card 6. Flips. Myth. You have to be completely broke to file bankruptcy. Reality. You need to pass the means test. If your income is below your state median, you automatically qualify. If above, you may still qualify based on expenses. Free calculators available online. Myth. You have to be destitute. Reality. You need to pass the means test. If your income is below your state's median, you auto-qualify. If above, you still might qualify based on expenses. Median income in Texas for a family of 2, $68,000. Make less than that, you qualify. 6 myths, all false, but the debt settlement industry needs you to believe them. Because if you knew bankruptcy was this accessible, this affordable, and this effective, and came with zero tax bill, you wouldn't pay them $5,000 to settle debt for pennies on the dollar and stick you with an IRS bill. Bankruptcy is almost always the better option, especially when you factor in taxes. So why doesn't anyone tell you about the insolvency exception? Or that bankruptcy eliminates the tax bill entirely? Because 3 groups of people benefit from you not knowing. Let me show you who profits from your tax bill. Here's where your money goes when you settle debt without knowing about the tax consequences. You settle $8,000 of debt for $4,000. First pipe, debt settlement company. They take 25% of your enrolled debt. That's $2,000. Second pipe, the creditor. You pay them $4,000 to settle. Third pipe, the IRS. You owe tax on the $4,000 they forgave. At 22%, that's $880. Total paid, $68.80. Original debt, $8,000. You saved $1120. Now watch what happens if you'd filed bankruptcy instead. Bankruptcy. First pipe, bankruptcy attorney, $1,500. Second pipe, creditor, $0. Debt is discharged. Third pipe, IRS, $0. No tax on bankruptcy discharge. Total paid, $1,500. Savings, $6,500. You seeing this? The debt settlement company and the IRS both profit when you don't know about bankruptcy or the insolvency exception, so neither of them tells you. 3 institutions had the opportunity to warn you about the tax trap. None of them did. Let me show you who stayed silent. Door 1. Consumer Financial Protection Bureau. Door 1. Consumer Financial Protection Bureau, CFPB, created in 2010 specifically to protect consumers from predatory financial practices. They've published consumer guides on debt settlement, multiple pages, warnings about fees, warnings about credit damage, warnings about lawsuits, pages dedicated to what to watch out for, mentions of the tax liability, one sentence, quote, "You may owe taxes on any amount of forgiven debt." No explanation of Form 1099-C. No mention of the insolvency exception. No mention that bankruptcy avoids the tax entirely. Why? Ask them. Door 2. Federal Trade Commission, Consumer Protection. Door 2. Federal Trade Commission, Bureau of Consumer Protection. They've sued debt settlement companies for deceptive practices, multiple cases, millions in settlements. Their consumer alert on debt settlement companies. 8 paragraphs. Covers fees, credit impact, risks, mentions of tax liability, half a sentence. Quote, "Forgiven debt may be considered taxable income." No form numbers, no exceptions, no alternatives. They know. They've seen the complaints. They've deposed the victims who got tax bills. They didn't warn you. Door 3. Internal Revenue Service, Taxpayer Advocate. Door 3. IRS Taxpayer Advocate Service. Their job is to help taxpayers understand their rights and resolve problems with the IRS. They publish the Dirty Dozen list every year, 12 tax scams to watch out for. Debt settlement tax traps never made the list. They see thousands of CP 2000 notices go out every year for unreported cancellation of debt income. They could publish a consumer guide. If you're settling debt, here's what you need to know about taxes. They haven't. Instead, they wait for you to get the bill, then charge you penalties for not reporting income you didn't know was income. Schofield narration. 3 agencies, all with consumer protection mandates, all with full knowledge of the problem. The CFPB could require debt settlement companies to disclose tax liability in bold text on the first page of the contract. They don't. The FTC could include tax warnings in their consumer alerts. They don't. The IRS could proactively send notices to people who receive Form 1099-C. You may qualify for an exception. Here's Form 982. They don't. Why? Because the IRS collects about $800 million a year in taxes on canceled debt, most of it from people who qualified for the insolvency exception and didn't know to claim it. That's not a conspiracy. That's just math. They don't have an incentive to tell you. So here's what you do. If you're already in debt settlement and you've already settled debt, here's how you handle the tax bill. If you're considering debt settlement, here's how you avoid the trap entirely, step by step. Scenario 1. You already settled debt. Scenario 1. You already settled debt. Form 1099-C is in your mailbox. Or you already filed your taxes and didn't report it, and now you've got a CP 2000 notice. Here's the protocol. Step 1. Calculate your insolvency. Get out a piece of paper. List all your debts on the date immediately before the settlement. List all your assets, bank accounts, car value, retirement accounts, property. Subtract assets from debts. If debts exceed assets, you're insolvent. By how much? Write it down. If your insolvency amount equals or exceeds the canceled debt, you qualify for full exclusion. Step 2. File Form 982 or amend your return. If you haven't filed your tax return yet, file Form 982 with your 1040. Check box 1B for insolvency. Enter the excluded amount on line 2. Attach your insolvency worksheet. If you already filed without reporting the 1099-C, file Form 1040X, amended return. Add the canceled debt to your income on line 8, then subtract it on Form 982. Net effect, 0 additional tax. If you already got the CP 2000 notice, respond in writing within 30 days. Include Form 982, your insolvency worksheet, and a letter explaining you're claiming the insolvency exception. The IRS will recalculate. Tax bill goes to 0. Step 3. Keep documentation for 3 years. Bank statements from the settlement date, loan statements, credit card statements, car title, anything showing your debts and assets on that date. If the IRS audits, unlikely but possible, you'll need proof. Keep it for 3 years. That's the statute of limitations. Step 4. Stop using debt settlement. Exit the program. Use the exit protocol from the last video. Negotiate directly with creditors or file bankruptcy. Every additional settlement creates another tax event. Even if you're insolvent, you have to file 982 every single time. Stop giving the debt settlement company fees and stop giving yourself tax paperwork. That's if you've already settled, but what if you're considering debt settlement right now? Different protocol. Scenario 2. You're thinking about enrolling in debt settlement, or you just enrolled and you're still in the first month. Here's what you do instead. Path 1. Consult bankruptcy attorney first. Path 1. Talk to a bankruptcy attorney. Free consultation, takes 30 minutes. They'll run the means test. Tell you if you qualify for Chapter 7. calculate what you'd keep versus what you'd lose. Chapter 7. Cost, $1,200 to $2,000. Timeline, 4 months. Tax bill, 0. If you qualify, this is almost always the best option. Legal discharge, no tax consequences. Credit starts recovering immediately. Find attorneys at abi.org/locator. Check your state bar association for ratings. Get 3 consultations. Pick one. Path 2. Negotiate directly with creditors. Path 2. Negotiate yourself. No settlement company. Call your creditors. Use the scripts from the last video. Offer 40 to 60% as lump sum or payment plan. They'll negotiate. They'd rather get something than nothing. Advantage, no company fees. You save the 25%. Disadvantage, you still get the 1099-C. You still owe taxes unless you file Form 982. But at least you're not paying $5,000 to a middleman who doesn't tell you about the tax bill. Path 3. Red. Debt settlement. Last resort. Path 3. Debt settlement. Only if bankruptcy doesn't work and you can't negotiate yourself. If you go this route, before you enroll, calculate your insolvency. Right now, today, are your debts higher than your assets? By how much? If you're insolvent, you'll qualify for the exception when the 1099-Cs arrive. Prepare Form 982 in advance. If you're not insolvent, meaning your assets exceed your debts, do not use debt settlement. You'll owe full taxes on every dollar of forgiven debt. The math doesn't work. In that case, bankruptcy or negotiate yourself. Those are your options. Schofield narration. 3 paths. Bankruptcy is almost always best. Negotiating yourself is second. Debt settlement is last resort, and only if you're insolvent. But here's the key. Calculate the tax cost before you enroll, not after. Run the numbers, factor in the IRS, then decide. Because the debt settlement company won't tell you, and the IRS won't warn you. And by the time you figure it out, you've already paid the fees and you're staring at a tax bill. So why does this system exist? Why does the IRS tax forgiven debt in the first place? And why don't they make the exceptions easier to claim? Let me show you the logic. Then you'll understand why it's designed this way. Internal Revenue Code, Section 61. Gross income means all income from whatever source derived, including cancellation of indebtedness. The logic: if you borrow $8,000 and only pay back $4,000, you've got $4,000 of economic benefit. You had the money. You spent it. You didn't repay it. From the IRS perspective, that's income. Section 108. Exceptions: bankruptcy, insolvency, qualified farm debt, real property business debt. The logic: if you're bankrupt or insolvent, you didn't actually benefit. You're still broke, so we won't tax it. Makes sense on paper. But here's the problem. Most people don't know Section 108 exists. The 1099-C doesn't mention it. The debt settlement company doesn't mention it. And the IRS? They send you the tax bill first. The exceptions? You have to know to claim them. Is that a design flaw, or is it designed exactly the way they want it? IRS Statistics of Income 2023. $814 million collected in taxes on cancellation of debt income. How much of that came from people who qualified for the insolvency exception and didn't claim it? The IRS doesn't publish that number, but I'd bet it's more than half. That's the system. It's not broken. It works exactly as designed, just not for you. Form 1099-C. The IRS says you owe taxes on forgiven debt. Form 982. You claim the exception that says you don't. The debt settlement company gives you the first one. They don't tell you about the second one. Now you know both. Calculate your insolvency. File 982 or file bankruptcy and avoid the whole thing. But don't let them stick you with a tax bill on debt you don't owe anymore. That's the IRS trap, and now you know how to avoid it. 3 resources. IRS Form 982. Free download at irs.gov. Search Form 982. IRS Publication 908, Bankruptcy Tax Guide, explains all the exceptions. Free download. Bankruptcy Attorney. Lookup abi.org/locator. Free consultations. Use them. One more thing about debt settlement they don't tell you. The Federal Trade Commission has sued these companies 17 times in the last 5 years. Millions in settlements. Every single company is still operating. Next time, why the FTC can fine them but can't shut them down, and who profits from that loophole. We're not done.